So what are the common mistakes to avoid when it comes to IAS 2 inventories? If you are writing financial reporting or corporate reporting, it is one of the fundamental accounting standards that you need to understand, because calculation of the closing stock helps us in the determination of the amount of cost of sales in the statement of profit or loss, the amount of gross profit, as well as determining the net profit for the year. It is also important for you to understand how to recognize the inventories on the face of the statement of financial position. But there are 5 key errors that you need to avoid in order for you to appropriately understand IAS 2 and know how to deal with any question involving this accounting standard. The first error is incorrect measurement. Primarily, you must understand that in accordance with IAS 2, inventories will be valued at lower of cost and net realizable value. And many a times, students fail to appropriately account for inventories well when it comes to dealing with the lower of cost and net realizable value. So always note that the closing stock of the inventory will be the lower of the cost, which is the amount at which the entity is carrying it, and then the net realizable value, which is the amount at which the inventory will be sold, less any cost to sell it. The lower of the two becomes the value at which the closing inventory will be carried out. Many a time students don't get this. So this is one of the errors that you need to make sure you avoid going into the exam hall in respect of IAS 2. The second mistake that you need to avoid is the costing method. It is important for you to understand that there are various ways that inventories can be calculated using either the FIFO method or the weighted average method. Now, it is always important for you to understand that there has to be consistency in the application of these methods in accordance with the qualitative characteristics of financial statement to enhance the comparability of the financial statement. And so there must be consistency in the application of the method used in accounting for the inventories, either the FIFO method or the average method. Always note that if the method changes, then that is a change in accounting policy, and in accordance with IAS 8 accounting policies, changes in accounting estimate and errors, that change must be applied retrospectively. What does that mean? It means that we are going to adjust the comparative figures in respect of the inventories and adjust the retained earnings as well in respect of the movement that is coming in due to the change in the method, so that it will enhance the comparability of the financial statement. So that is also another thing that you need to understand. Now, the way this one is going to be buried in the question is that it is going to be in the footnote. So as part of the footnote, the examiner is going to say that, during the year, the entity has changed the method of calculating the inventory from the FIFO method to the weighted average method or something like that. And we will be giving the data. So quickly, you have to know that, all right, this is a change in accounting policy. I need to adjust the previous year's inventory and also adjust retained earnings for that change in the costing method, and then know that it will be also affecting the current year valuation of inventories. So that is the second error you want to make sure that you avoid. The third error that you need to avoid is inventory write-downs. You have to make sure, in the first point we said, inventory should be carried at lower of cost and net realizable value. Now, it is important for you to understand that not recognizing inventory write-downs will lead to overstating of assets and definitely lead to overstating of the closing inventories, which will result into overstating of the gross profit and certainly the profit for the year. Now, as we said in the first point, we said inventory should be carried at lower of cost and net realizable value. So if, for instance, the cost of the inventory is $1 million, but the net realizable value, which is the selling price less the cost to completion and the cost to sell, is $800,000, then you realize that although the entity is carrying the inventory at $1 million, the net realizable value is $800,000. So the lower of the two is the $800,000. So the inventory will be carried at $800,000. Now, if we are going to carry the inventory at $800,000, then the $200,000 becomes an impairment in the inventory, which must be recognized as an expenses in the profit or loss account of the entity. So you have to make sure that you understand how to recognize inventory write-downs, as this can affect the actual figure when it comes to the inventory and the profit figure in the financial statement of the entity. The fourth mistake that you need to avoid is the valuation of work in progress. You see, when we talk about inventory in total, inventory is going to be stocks of finished goods, raw materials, work in progress, spare parts, and others. And in sometimes, if we are dealing with a manufacturing company, a typical manufacturing company, then as part of the closing inventory or as part of the inventory of the entity, we are going to be having work in progress. It is important you understand how to value the work in progress. And we must ensure that costs are appropriately allocated to the work in progress. This will not be that common for us in the financial reporting or the corporate reporting class. Nonetheless, it is something that you need to understand when it comes to the calculation of the cost of the closing inventory. Then certainly the last thing you need to understand is the disclosure requirement. As always, every accounting standard is going to be having some disclosure requirements that you have to know about. The same thing happens to inventory. And so when it comes to inventory, we have to disclose in the notes to the financial statement issues in respect of how it was measured, lower of cost, net realizable value, issues in respect of any inventory write down, how the net realizable amount was derived, and any other adjustments made. What costing method are we using to account for the inventory? That all these must be disclosed in the notes to the financial statement. So when it comes to inventories, IAS 2, these are some common mistakes and errors you need to make sure you avoid to position yourself to understand this fundamental accounting standard in order for you to pass the examination. Let me know if there are any other accounting standards you want me to share my thought on in the comment section. Make sure you like, share, and subscribe to the channel, and I'll see you in the next one.